We welcome on board PN Vasudevan, the MD and CEO at Equitas Small Finance Bank, and talk about how their numbers have been. Mr. Vasudevan, if we look at your advances growth, it was up 6% on a sequential basis, but then your interest income from loans has come in flat. How do you think one should read into this? Would you say that yields and advances also declined?
So we had an advances growth of about 23% for the full year. And if you see our yields on disbursement, that's actually been going up consistently over the last few quarters because we have fundamentally been trying to pass on a part of the increase in the interest cost to the borrowers. There is a lag time between the increase in the disbursement yield and its impact on the advances. So it's only a question of a lag. So normally there's maybe a 2-quarter lag before the yield on advances also starts catching up because we still be sitting on a large level of the old advances. So it's only a question of lag, and that's something that should come through. And if you see the NIM, yes, it's come down to about 8.17%. That's again because there has been nearly a 10 basis points increase in the cost of funds. And of course, our CD ratio, we have done a lot of work during the year. We have done a serious amount of work on the CD ratio. We started the year at about 100% CD ratio, and we ended the year with about 87%. So a lot of work has been done in that, and that of course does have an effect on the NIM.
Morning. So the cost of funds have been on a rise. Do you see visibility when it comes to rate cuts going down the line? What's the outlook?
So it's generally expected that the first half of FY25 is unlikely to see any rate cut is a general expectation. There is an expectation that there might be some marginal rate cuts in the second half. That's something that generally is believed. Anyway, coming down to our own portfolio, we had a cost of funds increase of nearly 1% over the FY24, and we ended the year with a cost of funds of 7.44%. But most of our old deposits have come up for maturity and repricing. So we are practically done with the repricing of old deposits at lower rates, converting it into higher, new deposits at higher rates. We are mostly done with that. So going forward, we expect that we might see a further increase in cost of funds by maybe about 8 to 10 basis points. That's what we expect. But after that, more or less, the cost of funds should become stable.
Sure. Your NIMs across the sector are also under pressure. You're also working to bring your CD ratio down to about 85% levels. What is the NIM level that you think the bank could find, comforting?
Yeah, so see, currently the exit NIM was 8.17% for the exit fourth quarter, and the full year NIM was about 8.35%. Going forward, as I mentioned, our CD ratio, we are down to about 87%, and we are looking to bring it to about 85% by March 25. So that gives us a full year to get the CD ratio down by about 2%, which is not much. So the impact of CD ratio on NIMs should not really have an impact for this financial year, unlike the last financial year. As I said, in terms of cost of funds also, we expect a 8 to 10 basis points increase over the next 1 to 2 quarters, which is also not much. So we broadly expect that, and as I mentioned, some of the lag effect of our disbursement yield will start coming up on the portfolio, advances portfolio. So I think on a combination basis, we believe that the NIM at the current level should be more or less sustained for the rest of the year.
Right. And again, on the net interest margin front, as per your commentary on the con call, you said that the product mix will be a key factor to decide the trajectory of net interest margins. But looking at your business segments, housing finance is growing sharply. You're coming up with personal loans. Overall, what is the outlook in terms of the mix, and how do you see that optimizing margins?
Yeah, so there will be some product mix changes over a period of time. As you mentioned, affordable housing is growing strongly, and the personal loan and credit card. Personal loan will be launched in the first quarter. Credit card will be launched in the third quarter. But for all of these new products to have an effect on the mix of advances will take some time. it will take some time. So I think in the very short term, if you're looking at a very short term like the FY25, I don't think the mix change should have much of an effect on NIM just for the short term, while it will have an impact on the medium term. But then hopefully the cost of operations also will come down over that medium term, helping us to retain the spreads at the bottom line.
Right. So while it is worth noting that we've not written off anything this year and credit costs did remain at about 1% for FY24, do you think you can manage to maintain the same for FY25 as well?
Yes, so mostly our portfolios come back to normal state now, the pre-COVID levels. So we believe that most of what happened in FY24 is sustainable and should be able to repeat forward going forward. From a credit cost perspective, we normally keep guiding for a 1.25% credit cost on advances, not on assets. On advances, 1.25% on advances is what we guide, and that's what used to be before the pre-COVID. So now this year, FY24, we have landed at a credit cost of around 1.05 or something like that. So we are very close to our normal. So I think you should expect anywhere between 1 and 1.25% credit cost for the FY25 also.
Looks nice. Right, and your gross advances growth was a little bit below what the estimate was. What's the outlook for FY25?
Yeah, I think we should expect to grow at around 25%. I think this 25% is something that we believe is sustainable, and that's something that we should be looking at on a reasonably medium-term basis.
Okay, thank you so much for taking the time out and joining us today.
If you like this video, then like, share and subscribe to ET Now.